Hello, friends. I am Anil Sharma again from Mumbai Leaders for Growth, and I welcome you again to this webinar series called Essential Business Upskilling for Business Owners, now running into part 3, right? So, again, while we have discussed in the WhatsApp group, let me share with you the purpose behind driving this upskilling for business owners and how upskilling helps you. So, some of you may actually wonder if the owners are already running their businesses, for so many years. Aren't they expert enough in all of the business areas? The answer is not that straightforward, right? Typically, what happens is SME owners are technocrats. When I say technocrats, they are specialized in their business domain, right? But as the business grows up, you need to become not specialized, but generalized, right? So that's the important aspect which I need you to take care of. And given that all of the science of management, business finance is practiced in corporates, how this knowledge is transferable to you, how it can help you upskill and help you manage a larger business. Because when you started your operation, it required a different leadership. But when it grows to a large business, then you require a different leadership, a different thought process than what you started it in the beginning. So today I have a practical, instead of going to an abstract story, let me give you an actual case study. So this happened when I, returned back to India in 2018 time frame, and I was introduced to a client in November 2018, right? And this firm is a Bombay-based manufacturing and trading business with annual revenue size that time of 24 crores in 2018. Now they have a manufacturing unit just outside Maharashtra, and also they import semi-knockdown kits from China and Taiwan for further assembly in a local factory. So what happens is this client subsequently distributes the finished product to about 5+ distributors in some northern states of India, and also has his own staff to sell products in the western and 3 states of southern India. So when I was introduced to this owner family in November 2018 through a reference, the mandate was we need help with saving our business because they had gotten into a jam scenario. They wanted to find out a source for new loans, and they wanted help on taking out money from the business because this business had become a money sucker for them. So the actual situation when I had my first session, the first and the second, digging in session with them, I found out that money was stuck in their working capital. Money was diverted into non-core activities. There was excessive deployment in a celebrity marketing activity, and the sales organization, they lacked metrics, and without metrics you can't do predictability in your sales. So once I help them identify the problem in terms of working capital, in terms of cash conversion cycle, the owners knew the plan of action. So they started to work aggressively to reduce both the aging stock, the inventory, which was old, and even required to go at a loss so that they could, liquidate and extract money out of it. And they went aggressively after collections from the market before introducing new goods into the trade channel. So what happened is this helped them free up working capital, and they avoided going for new loan altogether because they took the money which was there inside the business. They were able to extract it out. Second, what they did was they were able to cut down on long-term gestation projects, and they improved the management bandwidth. Now these were, shareholding family, and they were all over the place, various initiatives. So this improved their management bandwidth, and they were able to focus on their core operation. And third, they defined their customer objectives and fulfillment goals. And the same, once clear at the top, was trained down across the entire team, across the organization, with clear accountability defined for all the people in the organization. So now this was a series of meetings which happened. So after a year in October 2019, when I went in for my quarterly consultation review, their business metrics had all significantly improved. The owners and the managers down the line and the staff down the line all knew exactly what they had to do after they reach office the first thing in the morning, because this is what happens. People will come into their office morning, have their first cup of tea or coffee, and then straight away go into routine abstract activities like maybe talking to each other, looking at your email, figuring out what to do. No, this is not what is advisable. You need to know clearly what is my agenda today. So now these people, they work on a PDCA cycle, right? So what is a PDCA cycle? This is a management cycle called plan, do, check, act. So after you have done the plan for the business, you do the plan, you execute that plan. And when you execute that plan, when you do the plan, you check if this is going as per plan. And if this is going as per plan or not as per plan, then you act to rectify, to bring back the business on course, right? So now, having understood what financial metrics to track on a daily, monthly, quarterly, annual basis, this firm has set its annual budget plan. And within the next 5 years, they are on target to be able to bring in a new investor even and release what we call as value unlocking, right? So this is what, if you're reading the news nowadays, Reliance Industries is doing. They are doing a lot of value unlocking. They are taking out money from the business by getting extra, external partners, investors to invest in the business simply because they've grown the value of the business, right? So the point of this narrative being how important it is to understand financial metrics, right? You cannot do without it. And I'm talking of sturdy businesses. But as they say, you have to start acting the way you want to be, right? So if you want to be successful, you start to dress successful, you start to behave successful, you start to, act successful. How a successful firm would look like doing. So you have to start doing it today. So this is the objective of helping you ask the right questions from your financial statements and your chartered accountants and your finance team. As a business owner, it is important to be a technocrat, but it is also important to now be a generalist and be aware of the pulse of your business. So remember, only if you become a seeker will you receive insights. And with quality insights only, you can make a good plan and execute to win your game, right? Okay, a small abstract story now. So the title of the slide is Be the Boss. What do I mean? So the story goes like this. There is a horse suddenly came galloping down the road fast. And the man is just riding, right? It seemed as though the man wanted to go somewhere, very important appointment. And another man who was standing alongside the road shouted, hey, stop, where are you going? And the man on the horse replies, I don't know, ask the horse. So how come now this is the meaning? This is a Zen story. Actually, it has a powerful meaning behind it. So the horse symbolizes our habit energy. And our habit, the horse, is pulling us along here and there, making us run left, right, center, hurry everywhere, lots of activity, and we don't even know why, right? So if you stop to ask yourself from time to time, why exactly you are running around so much? Sometimes you might get an answer, but it's never a good one, right? It could be a weird answer. You're just used to it. It's how we are taught to live, right? But as much as we run, it gets us nowhere. We need to learn how to take back the reins of the horse, right? घोड़े की लगाम हाथ में ले लेनी है वापस से, अपनी हैबिट्स की लगाम हाथ में ले लेनी है वापस, और दिखाना है कि बॉस, असली बॉस कौन है, घोड़ा है कि मैं बॉस हूं, राइट? So you are the boss. You have always been the boss. So start acting like one. Now, be the boss, right? Okay. So now let me start with the business finance topic. And this is what I promised, how I can help you manage finances, right? And the first bit is the most commonly heard, uh, financial statement. It's called a P&L statement or a profit and loss statement. It is also called as income statement. So when you look up an income statement, what are the important questions or what are the important data points to watch in the income statement? How can you interpret, and what are the questions to ask from the income statement, right? So the first important point, what you do is you look at sales. Obviously, higher the better. We all we all like higher sales. But if there is a very high growth rate in excess of 30-35%, you definitely have to ask questions. Is my money at risk? Because most of the times, this sales might be credit sales, not cash sales. I mean, if the cash sales is going up by 30-35%, lovely, I love it, right? Then I just have to do my supply chain planning and continuously supply on cash. But if it is my credit sales rising above 30%, as a owner, be very careful. Where is the money going? Because it's your working capital, right? Second point is called operating profit margin. Now, again, higher the better. We love higher operating profit margin. But the way to look at operating profit margin is, if it has been fluctuating a lot over the years, what it means, it's a cyclical business, maybe it's a seasonal business. It means the company does not have the pricing power over its customers and is not able to pass on increase in the raw material cost to the customer. So this sometimes causes your operating profit margin to dip. So now you want to be very, very careful that how can I have pricing power in my business, right? So if you can have a pricing power that my cost can be translated to customer, my margin can be protected, right? So if operating profit margin is stable or maybe improving slightly over the years, then it means the company has sustainable advantage, right? You are set for a great period of time and you are able to pass on the increase in raw material cost to the buyers, to customers, to protect your own margins. Now, this is good. So these are the questions. Operating profit margin, I've told you what are the important parameters to look at, right? Then we are looking at something called as other income. Now, other income is a very important parameter. I mean, just this morning, I got into a long exchange with some of my other group friends, right? We were debating something about other income, and they started from a story which is being done in Reliance Industries. So we got into topic of other income. So it is always important because there is something called as one income, which is you are deriving from your operation. There is another income which comes from your non-operating operations. That means, so for example, if you have a lot of cash in the business and you're deploying it for some investment, so when interest on that cash or interest on any such investment comes into your P&L, it is termed as other income. It's not your operational income. Now if your other income is increasing, very good, right? And you have to always check if what is the return on this other income. So the income, if the non-operating income is not equal to at least the bank fixed deposit return on your investment, then you have to check that where have I invested, what is the quality of my assets. So other income is also very important parameter in addition to the main income, the operating income. Then there is something called as interest. We all want that we should have the lowest possible cost of interest. So always benchmark within your industry. Always look for cheaper sources of capital if you are availing of business loans or term loans. And of course, the fifth point on the income statement or the P&L statement, you want to focus on the NPM, the net profit margin. And obviously, the higher the net profit margin, the better. So, you have to be very, if I am a buyer of a company, this is what I look at as an investor. So I'm very wary of companies which show very high sales growth with declining net profit margin. Now, companies which chase growth at the cost of profitability usually do not create wealth for their shareholders, right? We go to the next slide. So now here is how I can help you manage finances and what to review on the balance sheet. Now, balance sheet is a like a black hole. Many people know the term balance sheet, but what is it, a balance sheet? People are not very conversant. They leave it to their accountants typically. But this is very crucial, and all large companies do take a strong, healthy look at it. So balance sheet is basically telling you how the funds in my company have come from various sources, and how those funds have been utilized in various activities. So it shows what is the fund source, and it shows what is the utilization of those funds. Have those been utilized properly? So when you have funds incoming into the company, and funds come from shareholder, funds come from loans, funds come from suppliers, these are called liabilities, right? And when you utilize these funds to buy assets, right? If you buy plant and machinery, if you buy finished goods, you buy, you make goods and you bill to customer, and that customer is an account receivable, and then you have cash in the bank, then you have inventory. So these are called assets. So a balance sheet shows source of funds and utilization of funds. Now, logically, the source of funds and the utilization of funds always has to be equal, right? You cannot have a discrepancy in between the two. So which is why we call it a balance sheet. So what question to ask in the balance sheet? The first question, large companies look at it. Debt. Debt is basically what is the loan that I have. The loan can be short-term loan. And when I say short-term loan is less than 1 year, or a long-term loan. Long-term loan is more than one financial year. So it's a long-term loan. So the parameter to watch is lower the debt, the better. Now, what does debt represent? Debt is like a loan. It's like living on funds which you haven't generated on your own, right? So it's like living life beyond your means. So now, do you want that? Maybe sometimes, maybe not sometimes, right? So if the business is going good, right, if there's boom time, you want to expand in your business, obviously you might not have generated so much of capital, so it's good to avail debt, right, to support your growth. But when the business is going down, like maybe today's time, you have a tight economy, what do? You reduce debt. Because what happens, your earning has gone down, but the debt stays. The interest cycle does not stop. It keeps on ticking. The clock keeps on ticking. So while your earnings may not come, but the interest keeps on ticking. So in times of economic distress, you reduce debt. That's the key parameter to watch in your balance sheet. Then look at the debt to equity ratio. So what is equity? Equity is the owner's capital into the business, right? Debt is external capital into the business. So now you are relying on two sources of capital, my own as a owner, and there is somebody else I have taken on a loan. So what is important is the debt to equity ratio always has to be checked. It is important to look at. It should be manageable, it should be balanced, it should be lower the better. And most important, you have to see, because I've seen few cases where a company had low debt to equity ratio, but still they faced financial stress, as sometimes the operating profit was not sufficient to meet the debt obligation. What is the debt obligation? The principal and the interest. So you always have to see how much is my earning. Am I able to pay my debt obligation on time? Because if I'm not, one check bounce and my company can be liable to be bankrupt, right? Third point in a balance sheet is looking at interest coverage. So higher the interest coverage, the better. Now, these are questions that you need to be asking, looking at your financial statements, asking with your chartered accountant, asking with your financial teams. That, and interest coverage is basically calculated as operating profit over the total interest outgo divided by total interest outgo. So how much of interest coverage am I generating through my profits? Is it sufficient? If yes, then my business is healthy. If not, then my business is at risk. And a similar ratio is called a current ratio in the balance sheet. Now, the current ratio is basically what it defines is a business, can it pay its debts due within 1 year out of the current assets available. So, for example, if a company has a current ratio of 1.5 is to 1, right? So that means 1.5 is the current asset and 1 is a current liability. So it means a business has rupee 1.5. If a current ratio is 1.5 is to 1, it means that the business has rupee 1.5 of current assets for every 1 of current liabilities. So if my asset is more than my liability, right, I am kind of comfortable. But if the ratio is less than 1, it's a warning sign. As one check bounce again can allow your creditor to file a case and you lose the credibility, right? Let's go to the third financial statement, which is called, here's how I can help you manage cash flow. And there are 4 parameters on the cash flow statement. So the first key parameter that you might want to understand is cash from operations, or sometimes people write it as operating cash flow. So always you have to check, higher the operating cash flow, the better. And what you have to compare is, always you have to compare the cash flow from operations to see with the net profit. Because technically or ideally, profit has to be equal to operating cash flow. If the profit is 100, the operating cash flow ideally should be 100. If the operating cash flow is going less than 100, say 90 or 80, what does it mean? It means that while you may have earned a profit in your P&L, but your cash, your funds are getting stuck in working capital, in doubtful debt, in aging inventory. So very important parameter, cash flow from operations. Second, you have to check is capex. Now, big companies undertake what is capex? Is a capital expenditure. So very important parameter which represents what is the money being spent by the company in its operations, which is not reflected in the income statement, because you might be building a new office, new equipment, new plant, new machinery. So what happens is external investors and banks, they always compare capex that you are incurring with your cash flow from operations to see that are you able to fund your capital expansions through your operating cash flow or not. And the companies want to, that achieve high sales growth with little capex requirement. They are liked by banks, they are liked by investors. So capex is an important parameter. The third important parameter, which is not so freely discussed, but it is very important to investors and banks, is what is the free cash flow that a company is generating. Now, have you heard of a business saying, um, turnover is vanity. Turnover is vanity. Profit is sanity. But cash is reality, right? So I'll repeat. Turnover is vanity. Profit is sanity. But cash is reality. So free cash flow relates to this reality parameter that you might be showing in your P&L statement, lot of profits. But in your free cash flow, if there is no free cash, then really it is all paper profit. That paper profit is at risk. You might be thinking, I can now take a big car, a big bungalow, but no, unless you have the free cash flow, you cannot take the money out of the company, right? So I believe if a company is not able to generate free cash flow, this company is not liked by bankers or by investors, right? And fourth important parameter is basically FCF to CFO, what I call it as free cash flow over cash flow from operations. So cash flow from operations is the total cash generated by the company. And out of that, free cash flow is the amount of free cash available to the shareholders, to the business owners. So very high portion of CFO, if cash flow from operations is 100 and suppose 80 rupees out of that is available as free cash flow, it indicates, okay, this business has a low capex, which is a great business. It's a cash cow business. You call it a cash cow business. So what is an example of a cash cow business? So for example, there's a company called ITC, right? With very little capex, with very little investment, they are able to generate a lot of free cash flow and return as good dividends to their shareholders, right? So FCF to CFO represents out of the total cash generated, how much is free cash flow that the owners can take out from the business. Now, the next slide is a routine expenses slide. So what you have to see normally is, are my expenses being well managed or under control. So what are the key expenses that you see? It is raw material, it is power and fuel, it is employee cost, it is selling and admin cost, and it is other expenses, right? And these expenses always have to be reducing or low. So the next slide is how can I help you manage looking at the operating metrics, right? Okay. So the key operating metrics is looking at how efficient is the management running the firm. So the key important parameter that you want to look at is the receivable days. Now, what is the receivable days? The receivable is a credit that you have given to customers. Now, how many days does it take for the customers to pay you back? So obviously, the lower the receivable days, the better. It means that the company is not giving higher credit period to customers to generate sales. Now, in terms of if there's a fictitious sales, fraudulent sales, then the cash will not be received from customers, right? So you always have to look at increasing receivable days. If it is increasing, then that's a problem. The second important element that you have to look at efficiency is the inventory turnover. So higher the turnover, the better the profit turns are for your business. So lower inventory turnover means that the company is accumulating a lot of inventory, which might become obsolete later, dated, aging later. So you want to look at receivable, you want to look at inventory. Then the third important parameter is the working capital cycle days. Now, what is working capital cycle include? What does working capital include? It includes receivables plus inventory as both. This forms the working capital. Now, what is required? Working capital cycle days, lower the better, right? It basically is showing that the management is running a very efficient operation for the business. And the last point over here, which I want to cover, is fixed asset turnover. So obviously, the higher the fixed asset turnover, the better. All of these parameters are typical operating efficiency ratios, which your accountant, which your CA can provide you. So what a high fixed asset turnover represents, that the company is able to use its fixed assets in a very efficient manner and does not require a lot of capex. And the more faster you turn, so if you are turning one cycle 5% margin, and if you do 4 cycles, you end up in a year getting 20% margin, right? So it's more of a fast rotation game. The faster you rotate, and the better it is for the business, right? So with this, I cover the key aspect of business finances today. Obviously, you might have taken some snapshots of the slides, and if you do have questions, you can write in till our time runs out, or you can send in and participate in the WhatsApp group chats, or email to me, or have a chat with me, right? If you have any queries, any feedback so far, please feel free to give your response. Great. So I hope to listen to you again through the various communication channels available. Thank you, and of course, stay safe. We have to learn to live with this situation for some time. So let's upskill ourselves. Okay, have a great evening, guys. Thank you. See you again.